Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for Wealth Press. And by the way, I want to thank you for all the wonderful emails you've been sending me at support@marketgeeks.com. If you're benefiting from this, if there's something you want me to add to this, if you're getting value out of this, send me an email. I want to hear from you. Support@marketgeeks.com. And if you've been sending them to me, I really want to thank you, and I really do appreciate them. It means a lot to me. I put a lot of effort into everything I do, and I really enjoy reading your letters. Thank you, and I'll always respond to you as well. So let's start off with the analysis. Markets are a little bit higher. The Dow is kind of flat. The NASDAQ is up 43 points. I'm actually surprised because, as I'll get into it in a minute, we've had some more negative news from Ukraine. I thought that the market, especially the NASDAQ, would be quite down right now, but it is not. Also, GDP was soft yesterday. And remember what I told you, if the GDP is soft, that means the economy is not growing as fast as we expect. And if the economy is not growing as fast as we expect, then the Fed can potentially back off from raising rates, which means bonds go higher instead of lower. And the last few days, bonds have been going higher, which gives the stock market a little bit of a relief to go higher because higher bonds means lower interest rates. Excuse me. I got hiccups in the morning. My God. So I'm looking for the bond market to hopefully hit the 50-day moving average. I would love to see it a little higher, but I am going to short it if it goes higher, aggressively short it. I have been patiently waiting for it to go higher, and it's been really slow. It's been moving with the trend because interest rates have been moving higher and the bonds have been moving lower. But in the last 1, 2, 3, 4 or 5 sessions, bonds have actually been moving higher, which is telling us that the Fed may not raise rates at the scheduled inflationary rate that they are planning. And again, the GDP was not a lot softer, but it was a little bit softer. A little bit softer is positive for the bond markets to go higher. And it's telling us that the economy is just slightly weaker. Now, we've got more data. We've got jobless claims, personal income today. That's happening in about 13 minutes. That's going to set the tone for today's trading action since the market is beginning to trade less and less based on the war and more on the actual fundamentals and technicals. And we've got tomorrow employment situation, ISM manufacturing index. This is going to be very important because it'll give us a good understanding of how the inflationary pressure and the supply chain bottlenecks due to COVID and other factors are impacting the manufacturing line. The employment situation will be important for the bond market, as will personal income and jobless claims. These are pretty big reports. Pay attention to the bond market. They impact the bond market a lot more than they impact the stock market. So again, remember, currencies, bonds, stocks. That's how it all works out. Let's talk a little bit about global economies, and then I'll talk about individual sectors, some major support and resistance areas, and ETFs. Because remember, today's Thursday, and we always pick the top ETF and the top option to go with it. Now, global stock markets sank yesterday after Chinese manufacturing weakened and Russian shellings around Ukraine's capital shook hopes for progress. Oil fell $5 per barrel, stayed above $100, which is the level I thought it would be way long ago before we even thought about anything that this war would start or even imagined that there would be a war. Since then, it's gone as high as 120, and I think it's going to stay elevated for quite some time. Although Joe Biden said he will release reserve to cool surging prices, they're not going to release all that much. OPEC and allied oil producers, including Russia, will be deciding today how much crude oil they will pump to the world. Russian forces were shelling areas near Kiev and another city after Moscow said it would scale back operations there to promote trust. Yeah, we have a lot of trust in Putin right now. Don't get me started. Virtual talks on trying to end the 5-week-old war are expected on Friday. I believe we are closer to the end than we were a few days ago. I don't think this is going to be one of those wars that lasts forever because Putin is running out of money and a lot of people are turning away from him because this war is just an unattainable win for him. Markets have mostly gained around this week as talks between Russia and Ukraine seem to show progress. Yeah, I'll see it when I believe it. Don't hold your breath. Investors also were worried about higher U.S. rates and a Chinese economic slowdown. This is very important because this war is not going to end, but these Chinese economic slowdowns can really impact U.S. economy because U.S. is the biggest importer of Chinese goods in the world. On Thursday, U.S. Department of Commerce issued a release saying, or will issue on release, that's today, that's coming up in 10 minutes, personal income and spending report for February. The Labor Department will release U.S. employment data for March on Friday. Biden is prepared to order the release of a million barrels of oil per day from U.S. reserves, according to two people familiar. That would come near to closing the U.S. production gap before the coronavirus caused a steep decline. I'm trying to read this fast so that we don't waste our time with reading this and just get into the analysis. But I don't think it's going to have that much of an impact. We'll have to take a look at oil prices right now. If you look pre-opening, let's take a look and see how oil's doing. They are down quite a bit. They're down quite a bit. Let's see. We actually have natural gas. Let's see how natural gas is doing this morning. Why is it so hard to get a ticker symbol on APA? Here we go. Yeah, down a little bit as well. Yeah, energy markets and natural gas, basic markets are down, which is why the Dow is down and the NASDAQ is up. This actually gives us a good understanding of why the Dow is down, but it isn't really down all that much. Again, looking at the bond market, I'm expecting bonds to go higher. I would love to see them go to the 136, 137 area. I want to sell them. In terms of individual ETFs, energies are still leading, but look at utilities, especially over the last month. They're definitely coming up. When we look at this graphically, it looks like energy is actually going higher. I know the chart. I know it's bearish today, but I'm telling you, energy sectors look pretty good right now. The utilities right now look like they're maybe a little overbought, but they may be going up a little bit more because these prices, energy prices, are going to be impacting utilities for quite some time. And my favorite sector right now is actually utilities. Basic materials, I mean, look at this. And we're near a breakout level. We need to cool off a little bit, consolidate for a few days, kind of like what we're seeing with consumer discretionary, but I wouldn't give it up. These sectors have been very, very strong. So has industrial. A little bit of consolidation and maybe some more upside. Real estate, I think, is going to pause a lot around here, maybe go down to the 46 level. It's a little overbought right now. Healthcare is a little bit overdone. I think a little consolidation near these areas. Financials also will consolidate, so we may see some consolidation. Consumer staples. Now, look at consumer staples. They're finally starting to rock and roll. I would be amazed if consumer staples did not go higher because they are right now in line of fire. Remember, we have shortages of things from China. That will reflect, and there's interest rates are higher. That reflects directly on consumer staples. Technology, consolidation, communication services, I think are going to start cooling off a little bit. So over the next few days, we could see some consolidation, higher volatility, but less directional range. I think the markets need to cool down a little bit, but not necessarily fall apart. So, and typically after long big moves, we either have a reversal or we have a long-term consolidation. So right now, the markets can either completely inverse what they did and go back down probably to the base, or they can build a new consolidation area around here, which is what I believe they'll be doing, and go higher. So over the next few days, we may have very little directional bias, but a lot of choppiness. Markets, especially these ETFs that I'm telling you about, they look tired. Probably the best way to describe this to me right now is the markets went a lot of directional bias. They showed a lot of directional bias, and they're tired, and they're looking for a new catalyst right now. They're trying to decide, is this war going to continue? Is this war going to fall back? Our COVID environment going to get worse in China or better? We are in the discovery process right now. I think markets want to go higher, but they're a little bit afraid right now. We are at crucial levels, as I said yesterday, and I think these levels are very meaningful. There's a lot of consolidation around here, but ultimately, I think we're going to just kind of huff and puff around here, maybe pretend like we're going a little lower, and then ultimately come up. But it would be kind of unnatural for us to think that after a rally like this, the markets will just continue going higher again. It's normal to have 2-3 day consolidations, especially in light of what I'm seeing right here. Everything looks tired. Markets look tired, and they look like they just want to kind of consolidate and stick with their natural levels right now. I hope that's making some sense. And again, a lot of this has to do with the fact that I've been doing this for a while, but also the fact that markets ran up so much. So after a run up like this from 320 to 360 on the NASDAQ, that's 48. Imagine the stock running up 48 points. in like 2 weeks. That's quite a bit. So even if that stock is going to continue moving higher, it's going to consolidate. Because remember, markets have 2 cycles. They trend and they congest. They trend and they congest. It's like staircase. And the longer they trend, they need to congest before going higher. The longer they congest, the better the upwards trend will be. So don't expect miracles right now from this market, and expect a little bit of a consolidation and a little bit of a cool down over the next few days. Now, volatility. Let's talk a little bit about volatility. Volatility is below 20. It's below 20. That means we are not in the level of fear we should be. Usually that comes with war. I mean, I think we'll go a little bit higher, but I'm not seeing a major spike like that unless NATO gets involved or there's something unforeseeable. Looking at the put to call ratio, we're at 87. We're back in the fear level, but again, we're mostly neutral right now. I wouldn't be focused too much on this at this time. I would be focusing on the following sectors. This will give away everything for you. Keep your eye on consumer discretionary. Keep your eye on chips, okay? Notice they're this is SMH, that's the chip semiconductor sector, and this is consumer discretionary. They look the same. If they start moving higher, both consumer discretionary and SMH, which is the semiconductor index, that's going to give us clues that this market is going to break out higher. If we can break above this level, that's it, we're done. New highs are on the way. So there's not much more here, so the market really needs to think twice before moving higher, because this is a serious position we're in. This is above the 200-day moving average and above the 50-day moving average. So if we see a breakout in consumer discretionary and semiconductors from here, the odds are very, very good that defensive stocks are going to cool off and speculative stocks are going to go back higher. If you see the energy sector really take up from here and go a lot higher. Notice it's kind of consolidating around here. If you see this sector going a lot higher, that means that the odds of seeing the semiconductors and the consumer discretionary stocks higher is actually much lower. So pay attention to energy versus consumer discretionary and semiconductors. It's like which one will go higher. That's the big factor. Now, as far as sectors and what sectors I'm liking the most right now, I actually like utilities, because I think utilities are between a rock and a hard place because energy prices have gone up so much. But I think utilities are a little overdone, and I actually like energies right now. I know it's a little boring. I know we've been talking about energies for a long time now, but I really like energies. And again, we have to follow the flow of things. Energy, basic materials, energy, and more energy. So why not stick with energy? Now, out of all the energy stocks that I'm seeing right now, the one that I'm really liking actually is Chevron. I like Chevron. I think Chevron will go up for a little bit, maybe to the 170 level, but I like CVX. It's obviously it's in the upper part of the range and it's moving along with the rest of them. But I like Chevron. I think Chevron has some more upside, and I like COP. So my favorite sector is still XLE, and my favorite stocks are COP or CVX. I may actually go long CVX this morning. Who knows? Now, folks, before I let you go, I want to tell you something important, educational, and something you may be interested in. Educational, like that. Joy of the Trade, head trader Jeff Zananeri. He just held a live class to go over his overnight heater strategy and how perfect it is for a volatile market. Now, it was a big hit. These trades are entered at the market close and they're cashed out the next morning. Tell me that wouldn't be cool, right? You get in the last hour of the day and you get out the next morning. You avoid all this overnight noise and your emotions don't get involved because you're literally in the market while the markets are closed. It's awesome. These heaters aren't just once a month thing. They're not even once a week thing. They happen every day from Monday through Thursday. Pretty cool, right? That's 20 trades a week. A month. And again, you don't have to, there's not a lot of capital allocation for them because you're getting in at the end of the day and you're getting out the next morning, no matter what. Who does not love that? I love it. The timing couldn't be better to add this strategy to your arsenal. Click the link below to learn how to use Jeff's heaters and find out what all the hype is about. You guys are going to love this. I'm telling you, you're going to love this. And tomorrow, weekly recap. Biggest winners, biggest losers. We'll talk about the trades that make money this week. We'll talk about everything to prepare you for next week. Follow the link below. If you're watching on the YouTube channel, go to the YouTube Wealth Press channel and follow the link below this video. In the description, there's a link to get in on Jeff's heaters. You guys have to check this out. And send me love letters. Support at marketgeeks.com. Bye. Keep your eye on energy sectors. They may be heating up again.